Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me typically, the man himself, the governor of the great state of Texas, Mr. Michael Becker, is not here again. He is on another due diligence assignment for his group over at SPI. We wish him and his group a lot of success. I think they just tied up another transaction. That guy is on fire. So congratulations to Michael and SPI. In the podcast today, we have the professor. Yes, we haven't heard from the professor in a while. So loan officer for Old Capital, Mr. James Eng. James, how are you?
I'm doing great. Thanks for having me, Paul.
So in the podcast today, we're going to talk about some things that are affecting the market these days that I want to make sure that you know what's going on. Because once you know, you'll be better educated on some of the options that can be done out there. But in the meantime, James, tell us what's going on in the Old Capital world for the conference.
Yeah, I mean, the conference is coming up here quick. So we're probably about 45 days out from our conference on October 24th and 25th. And so, I mean, I think some of the things that I've been, telling people about this conference is that I go to a lot of conferences. And a lot of conferences are in a hotel room where you sit there and you listen to panels and there's just no energy in the room. And I would say our conference is sort of exactly the opposite. We're going to have it at the House of Blues. We're going to have music, videos, panels, individual speeches, just a whole bunch of different things. And really our goal here is to connect you with the people that you need on your team. And whether that's listing brokers, property managers, investors, general partners, just whoever you need to add to your team, this is the place to do it. And so, we are going through sort of the registration process now. So go on to oldcapitalpodcast.com and get your ticket there.
What is really maybe the main difference from some other national conferences versus this one?
I go to a lot of conferences, and a lot of times you walk around, you'll meet people, and those people are, they maybe work for a big company and they're not really the decision maker. They're not really the investor in the deal. They just sort of work for those companies. Whereas at our conference, I think majority of the people there, 75, 80% of the people invest in real estate with their own money. And that's the big difference. So whether it's general partners or limited partners, those are the people that you're going to meet. I mean, I was at a conference just the past couple of weeks, and I could not find a true investor in a deal if I tried. So
there was a lot of vendors that were in the audience.
Either vendors or just guys who work for companies. They didn't put their own money into deals.
Yeah.
So I think that's what's more unique about our conference is that these are the people who are buying the deals, putting the deals together, who are coming out.
So fantastic. Go onto the Old Capital podcast and get your ticket. Again, this is a national conference. This is just not a regional conference. This is the one that everybody goes to that is in multifamily. You'll learn a ton of information. That is a Thursday and Friday. Come to Texas, come to Dallas, get to meet James Eng, the professor. He's the smartest guy in the room besides Michael Becker. So you'll really enjoy meeting some of the best in multifamily at the conference. And also a couple of different things. If you think that we provide value in this podcast, go on to the iTunes and leave us a 5-star rating, maybe a comment or two. We do very much appreciate that. We're trying to get 1,000 comments by the end of this year. Perhaps that's available, but we can only do it by asking you, can you do me a favor and give us a comment? We would appreciate that. Second thing is to go into Old Capital Podcast and download the, 17-page white paper report on multifamily financing. We are the biggest part of the equation. We're the lender. We're your biggest partner. You want to know how to react with us and how to figure out what the best way to get financing on your transaction. So download the 17-page white paper report and learn about what's going on with multifamily financing. Today in the podcast is kind of a page 18 out of the 17 pages that you've got to know. So page 18 is maybe a little bit of a yellow flashing light in the multifamily space. And we're going to go talk a little bit more about what's going on. Is there maybe a little bit of a problem with Fannie Mae, Freddie Mac? And what are some of the alternatives for financing? So James, I wanted to have the professor come in and kind of guide us about what's going on in the capital markets. What are some of the things that we should be aware of? What are some options? What are some turnarounds? How do we get these deals to work? So I don't want to see anybody lose any money. So we want to make sure that we're smart on how we put these transactions together. So James, what's going on in the capital markets?
So I would say that probably the last 30 to 60 days, we've seen Fannie Mae do two things. One is really increase their pricing, but then also reduce their leverage and the amount of interest only. And so what that has led to is people who are in transactions now, they're coming to us and saying, James, when this deal was 80% loan to cost on our loan and we got 5 years of interest only, it worked. But now you're telling me it's 1 year interest only and it's 70% leverage or 75% leverage. That just doesn't work for our investors. And so what are some of the alternatives? And we're going to use the analogy of the Old Capitol ice cream store here today. The past couple of years, I would say everyone's been eating vanilla ice cream cones. So we're going to cover a couple flavors. When you go into the store, the Old Capitol ice cream store has a lot of different flavors, but we're going to just go through the 5 flavors that we have on the market right now.
Fantastic. I can't wait to hear how this gets put together, but let's kind of walk backwards. I mean, we think that there's a problem, and we know that there's a problem going on with Fannie Mae and Freddie Mac. And so work backwards, James, and tell us what seems to be the problem about what's going on with probably the primary source of mortgage money on the multifamily side.
Yeah, I mean, at a high level, Fannie and Freddie both have caps of about $35 billion each. And, this year and the previous year, they've probably been doing 70 to 80 billion in volume each. And the reason that they've been able to do that is they've been doing green financing, and some of the affordable financing that they've been able to do has not counted towards their cap. And so they are pushing, maybe 60, 70% of the overall financing market for multifamily. Fannie Mae and Freddie Mac are the lion's share of financing. And so at the beginning of this year, they brought in a new leader for Fannie and Freddie, and that agency essentially said, hey, we need to pull you guys back a little bit here. And so that's what we've seen in the last 30 to 45 days is there's been a pretty big pullback from the Fannie side in terms of pricing and leverage.
Yeah, they have a new regulator that's in place with a group that kind of regulates Fannie Mae and Freddie Mac, a gentleman named Mark Calabria, and he's the new regulator for FHFA, which stands for the Federal Housing Finance Agency. And he's been there as a Trump appointee since probably the beginning of the year, sometime in the middle of April. And again, he is kind of tasked to curtail the GSE, the governmental sponsored entities, which is Fannie Mae and Freddie Mac, the kind of the too big to fail group. And so they kind of got their marching orders back about 9-10 years ago from the Dodd-Frank stuff, and nothing's really been going on. And so if you took a look at multifamily originations in 2007, it was about $150 billion. In multifamily originations in 2019, it was about $324 billion. So he is to direct the GSEs in the role of affordable housing. So I think we're starting to see maybe a little bit of a pushback. I don't know where it goes. Last week, the Treasury Department kind of pushed out what can Fannie and Freddie Mac do for single-family and multifamily housing. You can look at and download that 53-page report. In fact, we'll probably link it to the podcast here, so you can download it and kind of see what the big picture is and where they think they can do administrative changes within Fannie Mae, Freddie Mac, and things that they're going to need legislation to change on Fannie Mae and Freddie Mac. So again, they're trying to slow down apartments. If you had a history, a little bit of multifamily financing, if you went back, 15, 20 years ago, it was usually just one kind of rich guy or gal that would buy these properties. And they probably had 2 or 3 or 4 of their friends that would put equity into the transaction, and they were buying a $40,000, $50,000 apartment building. Then they probably had 4 or 8 limited partners to put cash in the deal too. So it was like one guy and a couple rich friends that will put money into these deals. Today, and as you have seen it, is that we probably have 3 or 4 KPs, key principals in the deal that are going to sign, on behalf of the partnership, and they're going to have 70 or 80 limited partners putting the money into the deal, and they're buying $150,000 per unit property. So the values have gone up tremendously in these properties, and the structure has really changed from how it was back 20 years ago to what it is today. There really wasn't any limited large syndications out there. There was just some rich guys putting stuff together. Today, they're looking for more depth of limited partners into these transactions. They're putting in $50, $100, $200,000 per limited partner into these deals, and they're buying them. And they're not only working on Class C properties of renovation 1, they're in renovation 2.0, 3.0, and they're just kind of working through it. So we're going to kind of talk a little bit about Fannie Mae and Freddie Mac kind of pulling back, because there's probably 2 levers that they can pull. One is by raising rates, and we've seen that quite a bit. The second one is really changing or tightening up credit and saying goodbye to some waivers that we were getting through Fannie Mae, Freddie Mac pretty consistently, and now not so much anymore. So just like what James has been talking about, is that we're concerned going forward what the lending environment is going to be and what type of impact that's going to have on you if you're a limited partner in a syndication, or if you're a syndicator and then you have hard money or about to have hard money trying to go into a transaction. So, James, let's figure out what's going on there.
Yeah, so I'm going to use the example of you walk into the ice cream store, you have a $9 million purchase price, $1 million in rehab. So all in, you're $10 million. And so you're going to have 5 options when you walk into the store. The first one is, option 1 is going to be your Fannie Mae program. And so Fannie Mae, right now, we're seeing them at about 75% loan to cost. So your $7.5 million loan, probably about $425 to $450 on your interest rate if you qualify green. And so this is going to really work for stabilized properties. So investors that are not necessarily, I would say, cash on cash driven, and they want the option of a supplemental, this Fannie Mae 1-year interest only is going to work for them. So that's what I'm going to call the vanilla ice cream. That has been what people have gone to repeatedly over the last 2 or 3 years. The second option, which I'll spend a little bit more time on, is the chocolate option, which I'm going to call CMBS option 2. And they are going to do 75% of your purchase price. So they're going to take the $9 million and do 75% of that. So you'll be 6.7. We are seeing pricing on this come in about 4% right now on deals. And they are doing 3 years interest only and even some full term interest only. So they do a 10-year term. They could do 3 years interest only and then even up to 10 years interest only. And so on CMBS, you really want the deal to already be stabilized, have limited rehab. And if you are cash on cash driven, I know a lot of syndicators are out there looking at, what's my average cash on cash, let's say over the 5-year horizon that I'm looking at, and they need that 3 years or 5 years interest only. CMBS is going to allow you to do that. But the big thing on CMBS, I would say, is number one, it's going to be a little bit more costly. So, you're probably $50,000 initial deposit. And then also the mezzanine loan or supplemental is going to be quite difficult to get on CMBS. And so when somebody comes to assume your loan, maybe on the purchase, they're not going to be able to re-lever the deal like they would on a Fannie Mae loan. And so on CMBS, we've seen some transactions in, I would say, probably secondary markets where, Fannie was at 1-year interest only and then 65% or 70% even. People are electing to go with CMBS because they're able to get the higher leverage. So 75% and then also 3 years interest only. So that's option 2, really your chocolate option. And then I'm going to move over to option 3, which I'm calling the coffee ice cream, which is the bridge loan. So this is high energy. Bridge loans can close fast. So they can close in 30 days if you want them to. But at the same time, your maturity window on your loan, so your loan term on most bridge loans is going to be 3 years. And so some people are able to get a couple of extensions after that, but there's going to be some restrictions around the extensions. But your initial rate we're seeing sort of 30-day LIBOR on bridge loans, probably about 30-day LIBOR plus 300 basis points, plus or minus 25 basis points, depending on where the deal is, the size of the deal, things like that. But that's what we're seeing. So your initial rate is probably going to be about 100 basis points higher than Fannie Mae or CMBS on the bridge. But the benefit of the bridge is they can go up to 80% loan to cost, right? So a $10 million deal, they can give you an $8 million loan, which reduces the amount of money you have to come out of pocket at the beginning of the deal. And then also when you exit the deal, so either through a refinance or sale, you're going to be at a 1% exit. And so, if Fannie and Freddie and CMBS come back and say, look, the debt service isn't there because the occupancy is low or the rents are low, and we're only able to give you 50 or 60% leverage on this deal, the bridge loan might be the option. And so that's what we're seeing. People, experienced investors who have confidence in their business plan that they can come in, raise the rents, and really achieve their business plan probably in 18 to 24 months, and then either sell the asset or refinance. Those are the people who are taking option 3, the coffee ice cream. And then let's move over to option 4. Option 4, I'm calling cookies and cream. So this is a little of a mix of vanilla and chocolate all mixed up together. There are a lot of people in the Fannie Mae space, in the CMBS space, and then there's a lot of private lenders out there who are sort of mixing the good of Fannie Mae with some of the CMBS stuff to give you a product that is sort of right in the middle, right? So they're giving you, let's say 75% leverage, and then they're giving you 4 to 5 years interest only. And they also are adding the ability to give a supplemental. And so in markets where Fannie Mae is not being aggressive, so let's say you go out to East Texas or West Texas and it's 65% leverage from Fannie Mae, but you're saying, look, I don't need the stress of a bridge loan and a 3-year maturity. Let me see what this private lender can do. Sometimes they're willing to go 10 years fixed with 4 to 5 years interest only. But you have to remember, this is still going to have either yield maintenance or defeasance penalty. And so the private lender is going to give you a little bit more interest only, possibly a little bit more leverage, but you're still going to have some sort of larger prepayment in option 4. So that's the cookies and cream one. And then the last one, which we used to do a lot of this option, the recourse bank loan. And I'm calling this ice cream flavor the Rocky Road, because some syndicators and general partners, they're allergic to nuts. And, some syndicators just won't do recourse bank loans. But on a recourse bank loan, you're really looking at, I would say, deals under a $5 million loan amount, and the occupancy and the rents of the property, so the cash flow that it's throwing off now, does not substantiate a 70-75% loan through Fannie Mae or CMBS. And so they're saying, look, I need more leverage. Fannie's at 50%. I need 75% on this deal to make it work. And then I also don't want to be stuck in the deal for 10 years. And so we're doing a lot of recourse bank loans on smaller deals that people are either buying by themselves or with a couple partners, where the leverage is at 70 to 75%. You're getting a 5-year fixed, maybe at 525 right now, 525 to 550, and you're having a step down prepay. And so we're seeing that on smaller deals that maybe are getting debt service constrained or yield constrained by CMBS lenders. And so I like showing you all these different ice cream flavors, because in the past, people have gotten used to going to the store and only getting vanilla, because vanilla tasted the best and it was the cheapest. But now all of a sudden the price of vanilla has gone up and Fannie Mae has gotten more expensive and it doesn't necessarily taste as good. And so I think that's where sometimes people get mistaken, is that they build a relationship with a lender who only has one flavor. And so I think that's one thing. We've gotten a ton of emails and calls in the last month just from people saying, I need more flavors than vanilla. And so we're able to, analyze the deal, sort of figure out what their business plan is, and then lay out 3 or 4 options for them, and then let them choose the best one that fits their business plan. And we do this early on in the process. So I really don't want you to call me and say, look, I'm 200,000 into this deal and I've got 15 days to close. I'd rather you call me before and say, look, we're about to put an LOI in, and before I put 100 or 200 or 300,000 down, I want to make sure my debt options are clear, because in the past couple of years, it's been relatively easy. We've had a lot of confidence in the Fannie Mae execution, but as that changes, it's going to become more and more important to get some certainty of execution on your debt.
Great information there. I love vanilla and have loved vanilla for all these years. But again, James says is that the regulators are really cracking down on Fannie Mae and Freddie Mac, and whether it is interest rates going up or underwriting that is kind of cutting back on what's going on in the market itself. So James, can you kind of reflect back again on our vanilla example? What are some of the things that you're seeing that Fannie Mae in the underwriting piece is cracking down on?
Yeah, I mean, I would probably start and use an example from, like, let's say 3 or 4 months ago. I mean, we just had lunch with an investor, and it was a good sized deal, north of $20 million on loan amount. And, he got 5 years interest only. He got a pricing waiver of 30 or 40 basis points off the grid. He got max leverage, and he had 3 or 4 KPs. And now that same deal, if we took it into Fannie, it'd be 1 year IO, probably 75% leverage, and the pricing there'd be no pricing waiver. And that's sort of the new reality for a lot of these deals. And so you just have to be careful when you're underwriting these deals on acquisitions.
Yeah, a lot of the syndication groups have been kind of pushing out there to their investors, not just 1 year interest only, not 2, not 3, not 4, but 5 or 6 years of interest only. And as you know, I do not like interest only. Kind of puts the property behind kind of the 8 ball, because it's got to catch up to whenever the principal starts to kick in. You better have rents up at that period of time. And because if you don't, and you're putting out distributions to the clients at just the interest only piece, then they're going to be in for a shock of less distributions coming out of the property. So 1 year of interest only is kind of a given within the DUS system, within the Fannie Mae delegated system. So that's where kind of their pen is. We can do 1 year of interest only, and that's at the higher leverage. If you wanted to try to do, say, middle leverage between, say, 70 and 75, or even probably below that, you would probably look for maybe 2 years of interest only, 2 to 3 years of interest only. And if you're below, say, 70% leverage in major markets, I would say, you probably could get 4 or 5 years of interest only. So that gives you kind of a perspective where it was not that way just, say, 30 to 60 days ago. So when you're doing your calculations and you're thinking you're going to get interest only, you better have a conversation with us so we can kind of go through it and just find out if that is actually even a possibility.
Yeah, and I mean, we've been working with a lot of our Fannie Mae lenders for a while, and so we sort of know how they underwrite and understand and review their underwriting before we push out a term sheet or a loan application to you as the buyer. But not everybody, I would say, has the same underwriting criteria and standards that we do. And so I would just caution any borrowers out there, if they're out there just trying to shop, maybe going to another ice cream store and trying to shop different flavors, make sure what they're selling you is actually ice cream. So you don't want to get into the store and they tell you one thing and give you something else. And so make sure you review their underwriting and make sure it's in line with yours and they're not promising you something that they can't deliver.
Yeah, a couple things also just in the future. Again, we don't know if this Fannie Mae, Freddie Mac kind of storm is a short-term storm. It's going to be a permanent problem coming down the pike, but we just want to get that information out to you. I mean, Fannie Mae, again, just like James says, under the cap business, these are transactions that don't have green or they don't have affordability. Fannie Mae is going to probably do, I don't know, they have $35 billion under the cap program, and total they'll probably do $70 to $80 billion. Freddie Mac, on the other hand, is probably going to do $35 billion of cap business, but may do $80 to $90 billion total of uncapped business in there. So there's a huge amount of some changes going on the affordability piece, because kind of going back to what Fannie Mae should be doing is help affordability for its tenants. And the second thing also too concerned with is probably secondary, tertiary markets. And I think we're going to see maybe a little bit more of a pullback in the secondary or tertiary markets or on Fannie Mae or Freddie Mac. And when I say pullback, I think less IO, maybe less higher leverage in these deals, maybe stronger sponsorships in these transactions. So look for that in the secondary, tertiary market. Make sure you talk with your old capital loan officer on that one too. And then maybe some pullback on the green programs and the affordability programs out there. And one of the things that's interesting too, I think what they're talking about is that these properties are starting to get rated. They've always been rated from say 1 to 5. And the concern that we have, 1 being the grade, 5 being not a very good property. So once you have bought a property, you're a KP, we put you in to that group and you sign on behalf of the partnership. You may not be an active manager in the deal, but you just signed as a partner in the deal to be a KP. A year from now, that property is not doing as well, and now you want to go out and do your own deal. Fannie Mae is going to come back and kind of do a check on you and see how you're doing. And if you're associated with that property that's not doing too well, that's going to jeopardize you going forward and doing your own deal. So make sure you keep the collateral and the asset in good condition. If you have signed on these deals, even though you weren't supposed to be an active manager on the deal, an active participant, that's how it was sold to you. If you're trying to do future business with Fannie Mae or Freddie Mac in the future, make sure that property you put your name on is doing well. Anything to add on that?
Yeah, I mean, I work with a lot of key principals, and I think if you are a general partner, I would almost take, a schedule of real estate template and fill that out as sort of like a one-pager for your limited partners, because you're going to get asked that information on almost a monthly or quarterly basis. And those are numbers that you should be tracking as well. But just so your limited partners have that information up front, because sometimes limited partners, even they might put 50,000 or 100,000 in these deals, keeping them apprised of what's going on in the deal on a monthly basis, I think is becoming more and more important as operations become super important at this time.
Yeah, condition of the asset is very important to Fannie Mae and Freddie Mac. They want to make sure that if you have put money aside to do repairs to the property, don't be holding that. Make sure you put that money back out into the property itself, and then you update the property, and then do the things that you said you were going to do. Be honorable and fix the things that the tenants need to be fixed on the property. And so keep on the good side of Fannie Mae. That means they're your biggest partner. Make sure that you continue on to be honorable with them. Not all loans are going to be perfect. We have to kind of figure out what works with you on the front side of the deal to make sure that we have the right execution. And so, James, talk a little bit more about this CMBS deal, because I think I've seen a lot of people try to say goodbye to Fannie Mae, Freddie Mac because lowering of leverage, lowering of IO. Can they do deals down to $1 million or $2 million, or what's kind of the sweet spot for CMBS? And by the way, tell us a little bit more about your background, because why are you an expert of this?
Yeah, I mean, if you rewind and go back to podcast number 11, I think I was on there, and we talked about CMBS. But yeah, my background was at G Capital, and we did 2 products. One was bridge loans, and one was CMBS. And so somebody came in the door and told us it's a transitional property. It's not stabilized yet. It went through the bridge program. But then on the same side, we also had CMBS. And CMBS is really more on the stabilized side. And so what GE would do was we would do an office deal, a retail deal, industrial deal, multifamily deal, and we put them all together. And some of these pools were over $1 billion of loans. And we put them all together, and then we would securitize them into the market where investors would buy different slices of that CMBS pool. And so one thing you have to remember about CMBS is it is very fast moving. Your rates could change very quickly depending on the sentiment of the market. And so not until that your loan is locked and you've pushed over money to really lock in the rate on that loan, is it locked down. So CMBS, I would say, has probably a little bit more volatility compared to the past couple of years that we've seen with Fannie Mae. But if you're buying a property that is stabilized, that you need more interest only, I would just be prepared to hang on to CMBS loans a little bit longer than Fannie Mae, because most of the loans are 10 years, and then your prepayment penalty is defeasance, which is a replacement of collateral. And so that is very similar to yield maintenance, and they probably add another 40 to 50,000 in transaction cost on top of your yield maintenance penalty to get to your defeasance.
Give me 2 reasons why to do a CMBS, and give me 2 reasons why not to do a CMBS loan.
Yeah, sure. So, I mean, I would say the number one reason right now that people are doing CMBS is the interest only. So Fannie Mae in a lot of markets is 1 year interest only. We've been seeing a lot of CMBS quoted at 3 years interest only, or even up to 10 years interest only. And then the second reason I would say to do it is they are quoting deals. So every time we look at a Fannie Mae quote, it seems like the all-in rate is higher and higher and higher. CMBS has not been doing a ton of multifamily. And so their spread on multifamily within CMBS has been extremely low. And we're seeing rates underneath 4 right now on CMBS on some deals, depending on the quality. And so I would say the 2 things to do a CMBS loan is, number 1, you're getting more interest only. Number 2 is you're getting a lower rate. The 2 reasons that I would say you probably should not do a CMBS loan, number 1 is if you want any flexibility in the exit in the next, I would say, 2 to 3 years. Number 1, CMBS typically actually has a 2-year lockout a lot of times. And so
what does that mean?
That means you cannot prepay this loan no matter what. So if you buy this deal that we were talking about for $10 million, somebody comes in tomorrow after you close and says, I will pay you $20 million. You cannot prepay that loan no matter what. And so we've been in an instance when a seller put on a CMBS loan and he didn't realize it was a CMBS loan. And he went to sell the property 6 months later, and we got to the closing table and title told us, we can't prepay this loan because we can't have a payoff. And that payoff, without a payoff, you did not have clear title. And so number 1 reason not to do CMBS is if you are repositioning a property significantly, or you think you're going to sell this property in the next 2 to 3 years, then it is not a play for CMBS because your prepayment penalty will be extremely large, or you will be locked out of the deal. So that's probably the biggest reason to not do a CMBS loan.
Now, is there a thing called a supplemental on a CMBS, or is it called, what's the other word they call it?
Yeah, I mean, supplemental I think is more specific to Fannie Mae and potentially Freddie Mac. That's sort of a second loan that you can go back to that original lender. So if you do a loan, let's say with let's just use an example, Fannie Mae lender, like a Wells Fargo, for example, and 2 years from now, you've improved the property. You think, you can go back for a supplemental, maybe pull out half of your equity. You just call Wells Fargo and go straight back to them and put a supplemental behind yours. But with CMBS, these first mortgages are pulled together and then they're sold off into the market. So investors have bought little pieces of all these loans. And now you come back to the servicer and say, hey, I think I've improved the value. I want a $2 million supplemental. They're like, well, we don't do supplementals. You can add what's called a mezzanine piece or a second mortgage, but you're going to have to go out there into the secondary market and find someone to do a $2 million loan on your property. And then once you find that mezzanine lender, then you're going to have to take it to the servicer of your loan and ask them to approve it. And so we have not seen a lot of those. And so I would leave it open in your loan documents that you can add mezzanine, but I would not count on it in my 5-year projection.
I would not count on it. And then the other piece of the puzzle is that mezzanine typically is not cheap. And so if you're looking to pull cash out of your property, what kind of a rate would you think you would get on a $2 million supplemental using your example?
It might be 10%. Right.
Maybe 16.
Yeah. So it might be 10 or 12% depending on the market. That's why, I think Fannie Mae supplementals historically have probably been 100 basis points over sort of your first senior mortgage piece. But when you go out to the secondary market, they really want to do, I would say, probably $5 million loans and higher on the mezz piece, and they just don't have that time for $1 million or $2 million mezzanine piece.
Yeah, no way, because all the work that was done up front has to be redone again. You got to get the comfort level of the senior lien holder, the servicer in the deal, to make sure they're comfortable, because they have to figure out, well, if you're getting $2 million out, how much debt service is that second lien going to have, and is there going to be an impairment on the first lien. And I would tell you that a lot of times they're going to say, we're not going to do that. So I wouldn't even count on a mezz piece on a CMBS. I mean, that just doesn't happen. CMBS is really set it and forget it. And so even if the property went up in value, these loans are assumable. So the next buyer coming in can assume the balance of the loan that you're currently at, provided it's not during a lockout. But they're not going to be able to leverage it up or size it up. And if the seller were to pay it off early, they would incur a large defeasance penalty on the deal. And so we haven't had a problem with, say, large yield maintenance penalties because the market has kind of cured all problems. Everything has been going up, but I just don't know if that's going to be the way in the future. And so you may have to hold on to this property. If you take it out for 10 years, you may be having to hold the deal for 10 years. So talk with your loan officer on that to kind of figure out if that makes sense. Anything more on that, James?
No, I mean, I think, on CMBS, one more thing is really once they fund your initial funding at close, that's it, right? So if you want the lender to roll in rehab and things like that, CMBS is really not the play for you. It's really just the initial funding on the existing cash flow. So if a deal just is below market or below occupied, you really want to do the CMBS loan. So a good example of when people would do CMBS loans is when somebody would take a property and lease it all the way up. So it might be an office building, a retail building. Once it got up to 90, 95% occupancy, then that's when they would use the CMBS loan. Mm-hmm. They would not use the CMBS card until they had the deal sort of fully stabilized and had sort of maximized the value.
Let's kind of walk through just very quickly on the bridge product. I mean, I know that you do a lot of bridge loans because it does give you flexibility on the exit of the transaction. Talk to me just kind of a deal that you're working on right now that why did they have to have a bridge loan, or why did they want a bridge loan, or why didn't they do Fannie Mae?
Yeah, I mean, Fannie Mae was 75% 1-year IO. And so a lot of these syndicators, they just can't, with the 1-year IO, just make deals work as easily. And if you're buying a deal where the rents are below market, Fannie Mae is going to look at in-place rents, whereas the bridge lender is going to look at your pro forma for years 1, 2, and 3. And so if there is a lot of upside in the rents, then the bridge lender is going to give you probably partial credit for that. And so they're going to give you the benefit of the doubt that you can execute the business plan, put in your CapEx, and then, refi us out by year 3. And so for syndicators who want a little bit more flexibility in that year 2 and year 3, that's why they chose the bridge loan, because it's a floating rate. And so they only have a 1% exit on the deal.
And typically bridge loans, I mean, and again, these are non-recourse bridge loans. What loan amount do they usually start to do the non-recourse? Because you can still do bridge loans, but they're usually going to be below X amount of dollars. So walk me,
I would say,
where does it start and where does it end?
Yeah, I would say for non-recourse bridge, most of the competitive bridge loans on non-recourse about $5 million in loan amount. There are some non-recourse bridge loans in probably the $2 to $3 million range and up, but I would say the pricing gets a little bit more expensive in that space. And so typically $5 million and up will get you a non-recourse bridge.
And then the Rocky Road, which is the recourse bridge loan. Where does that start? Where does that end?
Recourse bridge loans, I mean, they can start at $100,000 if you want them to, but most of the time, I would say $1 million to $5 million is sort of the recourse bank loan range. And I would say those people who are taking that typically want that step down prepay. And I mean, I was just talking with a recourse bank lender, and it's been crazy that Fannie Mae has been sitting in the 3s and 4s, and recourse bank lenders have been in the 5s, 5.5 on the multifamily stuff. So I think they've been twiddling their thumbs, and now they're starting to get some calls on this recourse bank loan. So, let us know.
And on the recourse and non-recourse, I mean, that's not hard money stuff. I mean, that is rates in the low 4s and mid 5s or so. So it's not 10 or 11%. I mean, so people take these bridge products just because they need the flexibility of the prepay typically and the higher leverage in the deal if it's possible. But you do run a risk that because On the non-recourse loans, they have a hard maturity. You've got to pay this loan off in X amount of years. So try to, just like James says, try to get all the work done within 18 months if you can, and then come out either to sell the property at the 24th or 25th month, start the marketing process if you want to sell it, or look to do a refinance at that period of time. And hopefully the markets are up and we have no problems with that. Kind of the same thing for the bank recourse. I wouldn't do a large bank recourse. I mean, you're exposing your balance sheet to that. But if it's a small deal, $1, $2, $3, $4 million, and you have a pretty good balance sheet. Another thing is on the bank balance sheet stuff, tell me a little bit about what type of equity in terms of a percentage that a LP or a KP needs to put in, a sponsor needs to be put in versus, say, Fannie Mae or CMBS. Because that's a big difference. People don't understand that.
Yeah, Fannie and Freddie, I would say probably in the last couple of years they really wanted you to have 10% cash equity in the deal, right? So on our example, let's say you had $2 million equity that you're totally raising. The sponsors who are signing on the loan, they'd want $200,000 in equity in cash for the deal. A lot of these recourse bank lenders, they're going to want north of probably 25% from the sponsors. And I know some banks are, they even want 51% just because everyone's signing on a loan. They want to have control of the deal. And so, I mean, it is a smaller check, right? So if you're doing a $1 million or $2 million loan and your equity is $500,000, then it's a little bit easier to come up with that higher percentage. But it is a larger percentage of the equity.
And what's the thinking behind that, just on the banking side?
Yeah, I mean, I think from their perspective, they're saying, look, if this deal goes sideways, who am I going after? And they're really, Fannie and Freddie, they're looking probably 75% of the property, 25% of the borrower. On the recourse bank lenders, it's probably 50-50 on most deals. They'll take back the property, but they're going after you personally for any deficiency on that foreclosure.
Wow, some great information on that. And we definitely thank the professor and all of his words of wisdom on this. Is there anything else that, limited partners need to know? Anything else that general partners need to know? And as I say, will this be covered on the test at the Old Capital Conference? I
would say you get to meet all of these different lenders and sort of talk to them about their different products. And I think one unique thing about the conference is talking to people who live and breathe these loans every day, from investors to the actual lenders on these deals and people who service them. And, we work a lot up front on the deal, but you remember, you're taking out a loan for 10 years on a lot of these transactions. So working with that lender and that servicer is very important.
Is it good to have many different flavors of ice cream when you're dealing with Old Capital?
Absolutely. So definitely come out to, maybe at the conference we need to have some ice cream at this year's conference. I think I'll put in that request and see if I can get it done. That's great. Some great information from James Zhang. We do appreciate him spending some time with us. Go on to the oldcapitallending.com to get more information about James and some of the things that we do and some of the transactions that James has closed. Great wealth of information from James Zhang. We do appreciate it. And so hopefully we'll see you at the conference coming up here shortly. Go into oldcapitalpodcast.com and RSVP for the conference. We appreciate that. Again, anything more, James? That's it. Thanks a lot, Paul, for having me. All right. James Zhang, I'm Paul Peebles. Have a great day. We wanted to give you an update on the podcast today. We've had a little bit of a change in the last 90 minutes, and so we wanted to get that information out to you. On September 13th at 9 a.m., the FHFA, which is the Federal Housing Financing Agency, which oversees Fannie Mae and Freddie Mac, announced a revision of cap structure for the multifamily business for Fannie Mae and Freddie Mac. So the new multifamily loan purchase caps will be $100 billion for Fannie and $100 billion for Freddie, for a combined total of $200 billion to support the multifamily market. And that's for the next 5 quarters, beginning October, November, December of 2019, ending at the end of the fourth quarter for 2020. So the new caps apply to all the multifamily business, no exclusions. So a little bit what this means is that we used to have $35 billion in cap business, and then we would fund loans under the affordable and the green programs up to about $70 or $80 billion for Fannie, and pretty much almost the same numbers for Freddie. So it looks like they're going to do something about the affordability piece and the green program, and they're going to put everything under this one cap of $100 billion.
So in the last couple weeks or a month or two, it's been a little bit like of a log jam. It's been a little bit of having a river that's been shut down, that the water or the money has not been flowing through. So this is probably good news that we're going to start to see maybe some money that's going to be able to be released to Fannie Mae and Freddie Mac, or at least the people that are doing transactions or in the middle of transactions with Fannie and Freddie, that they don't have to worry about not getting funded. I will tell you very scary parts of that we don't know because it's such a fluid situation, what the impact's going to be for interest only and what type of leverage that's going to be in interest only. Maybe you'll get just 1 year, maybe you get 2 or 3 years, but we don't know that yet. We don't know what's going to happen with the waivers still. Nothing has been said in this document that just came out. We'll put this document up on the podcast website so you can download it and take a look at it. But we think it is positive news that the logjam has been released a little bit, but we don't know what the impact's going to be for interest rate costs, or what the all-in interest rate is going to be on your mortgage on your apartment building. But we would think that would probably go down, and that because they were trying to slow it down or stop it because they were just running out of money. And now this is a little bit of a log jam breaker. And so we think it's positive news. But again, it's a fluid situation. We just don't know exactly what's going to go on. So again, thanks for listening to the podcast. Thanks, James Zhang. We appreciate it. I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.